If you're a business owner, you do not want to miss this episode. We're going to dig into the lifetime capital gains exemption, tax-free money to you. You want to know this stuff. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina White. Christina, how you doing today?
Hi, Darren. I am doing awesome today. Excited for another podcast for the business owner listeners out there, and just really excited to dive into this one.
Yeah, and more tax-free stuff, right? I mean, this we love talking about tax-free stuff, and for individuals and business owners, and this one is hopefully going to be real impactful for the business owners out there.
For sure. But before we jump in, I want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you are listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to give us a follow on our social media at Control and Compound on Instagram and TikTok. And for this one too, I am going to add a bit of a disclaimer. So Darren and I are not accountants. We're not lawyers. We do work with business owners every day. So we have some background on this stuff, but anytime that you're dealing with taxes, tax provisions, such as the lifetime capital gains exemption, you're going to want to be working with a professional that knows their stuff. So you're going to want to refer to a lawyer, accountant, and then as well your financial advisor when you're that specializes in these types of setups.
Okay, so lifetime capital gains exemption. Let's start with the basics. What exactly is the lifetime capital gains exemption, and why it's so significant to Canadian business owners? If we go back in time, this was started in 1986 by Finance Minister Michael Wilson under Brian Mulroney's first term as Prime Minister, and it was really put in to say, okay, as a business owner, you take immense risk. You put your life savings into something, blood, sweat, and tears, hope to create jobs, largest employers of people out there in the country. There's got to be some reward at the end of the day, because we don't have government pensions like government workers or provincial government, federal government workers, or some union people. We don't have those pensions. So when we go to sell our business, they said, okay, we're going to allow some of that money to be tax free. And when it started in 1986, it was a $500,000 lifetime capital gains exemption. So the lifetime capital gains exemption is an exemption that certain amounts of capital gains when you go to sell certain qualifying properties, and we're going to dig into which certain qualifying properties are exempt. But it's a big tool. It's a big tool for business owners, for farmers, and for fishermen. So really, if you own a business, you own a farm, or you're a fisher person, that's what you want to be focusing on, those people and their capital gains exemption. So that's kind of what we're going to talk about today.
Yes, exactly. So we're sheltering a certain amount. Now, you mentioned that when it first started, it was a $500,000 lifetime exemption. Well, now the lifetime capital gains exemption in 2024, it's actually grown. It does index with inflation every year. And for 2024, the sale of a qualified business shares will be $1,016,836. That is the amount that you can shelter from tax. That's up from 971,000 and change in 2023. So we did see an increase of about 45 grand over the last year. So a 4.7% increase, which is the federal indexation rate. So we saw that increase. That's on the qualified business. On the farming and fishing property, they were actually a little bit higher last year at $1 million. They had been around $1 million for a bit, and there was an increase there as well. So now they're actually the same. So $1,016,836 in 2024, and that was an increase of about 1.7%. So that's what we're looking at for today's lifetime capital gains exemption. If you're listening to this podcast in the future, it is important that you go back and you check out what you're listening to us today. That year, this is 2024. It does change every year. So like I said, since 2015, it's been going up. One thing to mention with this increase is that if you have not used the full amount previously, so let's say you did use it back in when it first started, the 500,000, and we've seen that growth on it since, you are then entitled to that new amount. So that 600,000 or so that you'd be entitled to from not using it or 500,000, sorry, that you'd be entitled to because you hadn't used it previously. So it is always growing. There's an amount that's provided at the beginning of each year to let you know what that lifetime capital gains exemption for that year is going to be.
Yeah, that's cool, Christine. I bet you 99% of the listeners didn't know that. Like, if you already use your capital gains, you think, oh, you can only use it once. It's one lifetime. But all those increases mean you've effectively created more room. So if you have another situation you can use it in, take advantage of it.
Yeah, exactly. Now, we did say that we dig into, so we say that it has to be qualifying. So what types of, let's dig into a bit more of what types of properties and assets are going to be able to qualify for that capital gains exemption.
Yeah, I mean, the big ones again are corporations, farms, and businesses. But when we say corporations, they need to meet certain criteria, right? Say CPC, Canadian controlled private corporations. They've got to have so much of the assets in active business income and stuff. But typically, what we're talking about is farms, fisheries, and incorporated businesses owned and controlled by Canadians. But you really got to meet these certain criteria.
Gotcha. So I think we should do, and I love showing examples of what this would look like real life. Can you provide a couple of examples of what this would look like if you're selling your business today?
Okay, sure. So let's look at a typical sale of a business, and we'll just use a number of $1 million, and let's look at the two most common ways you can sell a business, because this is really important when we're talking about this lifetime capital gains exemption. So the two most common ways to sell a business, number one is called an asset sale, and number two is called a share sale, right? An asset sale means you're not technically selling the shares of the business, you're actually selling the assets. So let's say you're a construction company and you own a bunch of trucks and backhoes and all kinds of equipment. Well, a buyer could come in and say, okay, I'm going to give you $1 million for those assets. Okay, I'm going to buy those assets. And a lot of buyers, we won't dig into it, a lot of buyers want to buy assets. Okay, if you sell it as an asset, then that is not eligible for the lifetime capital gains exemption. Okay, asset sales are not eligible. Now, maybe if they pay you enough on the asset sale, you're okay not getting the capital gains exemption because you're making so much more than you would if you sell shares. Again, talk to your professional. The second way to sell your business is to actually sell the shares. So you're going to sell the shares of your corporation. Another individual is going to buy those shares. When you sell those shares, you're eligible for this lifetime capital gains exemption of $1 million. So let's say you're an entrepreneur and you started your business with nothing, right? You just one day you said, okay, great, I'm going to start a business. You started it. Those typically have a share value starting out of $0 or $1, right? So we'll just assume 0. So you started the business from scratch. You sell it for $1 million. You have $1 million capital gain. If that company, when you sell it, meets the criteria to be a qualified company, that full $1 million is going to be tax-free to you as the shareholder. You will have used your entire lifetime capital gains exemption, and that $1 million is tax-free. Put that in perspective. Let me give you one more example. Let's say you bought shares in a company. So you bought an existing business for $500,000 a couple of years ago, and then you sell that one for $1 million. Well, you don't have $1 million capital gain. You only have a $500,000 capital gain. So you could use half of your capital gains exemption and say, great, I'm not going to pay tax on that 500,000. So again, great way to use it. But simple example, you start with nothing, you grow a business to $1 million, you sell it, you get that $1 million tax free if set up properly, structured properly, et cetera.
Okay, so great example, Darren. What would the tax have been if you did not use the lifetime capital gains exemption in this example?
Yeah, great question. So in that same example, the $1 million completely tax-free. If I didn't have the capital gains exemption, you would pay roughly 25% tax on that, or $250,000. The way it would work is just think of the top tax bracket in your province, divide it by 2. Because $1 million capital gain, 50% inclusion, you pay tax on half of it, assuming the top tax bracket. So in Ontario, 53% divided by 2, about 26.5, or $265,000 in tax versus 0. Big difference.
That's huge. Definitely not something to leave out of the planning, that's for sure.
Now, Christina, questions we get all the time. Can I use part of my lifetime capital gains exemption?
Yes. So the answer to that question is yes. You mentioned it a bit earlier, but if you were just selling that corporation, you only needed to use 500,000 for the lifetime capital gains exemption. You can just use the 500,000. You're going to be able to hold on to that other 500,000 at this point. And as I talked about earlier too, if we see growth in the lifetime capital gains exemption limit, you're also going to be able to tack on that room for yourself too. So answer is yes, we can use a portion of it and we can carry it forward.
Cool, Christina. What about can you multiply that capital gains exemption by using other family members?
So this is a very popular question. We want to know about this one all the time. Can I use other family members, spouses, kids? So the answer to this question is yes. If you have another shareholder inside the corporation, so if your spouse is a shareholder in the corporation, they can use their lifetime capital gains exemption. So keynote there is their. So their capital gains. It's not yours, but you and your spouse both own a corporation. Well, then yes, you've got $2 million that you can use tax-free on the sale of that business, which is awesome. Now, keep in mind that they're going to receive the check for the sale of that business. So if you are using family members, you definitely want to have your lawyer, your accountant involved. This is not as straightforward as it sounds. If you're, getting into kids and other individuals, you definitely want to talk to a professional about that. And then keeping in mind that you are using theirs. So it's, they no longer have one and they're receiving that check on the sale of the business.
Yeah, I mean, you can get into family trusts and kids and stuff, but again, we're not going to dig into that level of detail at this podcast. We're happy to have a one-on-one chat with someone about it, or with your accountant. But yeah, if you start multiplying these capital gains exemptions, it's real important that you're getting good advice, because you mentioned it's their capital gains exemption, not yours.
Absolutely. Another big question, important question, and I think this is something that, you have to keep in mind and keep focused on when the plan is to use this, is you hear the term qualified small business. So there's specific conditions and specifications that individuals really need to be aware of when they're applying for that lifetime capital gains exemption. So Darren, maybe you could give a bit of a bit of information background on that when it comes to being a qualified business.
Yeah, and if you talk to accountants like we do all the time, you would not believe the amount of business owners that don't do the proper planning and then are ready to sell their business, and they're like, "Well, what do you mean it doesn't qualify for the lifetime capital gains exemption? That was my whole retirement strategy, to sell this business and get some tax-free money." So one of the things that are most commonly come up is when you have too much cash or investments inside that corporation that you're not using for active business income, right? So if you've got a bunch of stock market stuff, Bitcoin, not rental real estate stuff that isn't actively part of your active corporation, that's really going to set you offside, they call it. So you're not going to be eligible for that lifetime capital gains exemption. So that's why, a lot of business owners have holding companies. Once they have surplus cash or investments, they're sliding that money into a holding company to keep their active business pure. So when they do go to sell it, it's going to qualify for that lifetime capital gains exemption. So biggest one is make sure you're not sitting on too much cash inside your corp. That's why you want to create a holding company. There's other advantages to holding company too, but that's one of the big ones, is you want to keep that active business pure.
Yeah, and they do look back a few years too. So it's not something that you can be like, okay, ready to sell. I'm going to clean this up, move the cash, and it's all done. They go back a couple of years. So it's definitely important that you speak to your accountant, your tax lawyer, your team, right? Your team a couple years before. And we say about 2 years, but I would say start as soon as possible, right? The sooner you start planning for these things, the better position that you're going to be in when you get there. So minimum 2 years. But again, if you're listening to this and you haven't thought about it and you are a small business owner, time to put that into the planning now. This is a huge tax benefit.
Yeah, and like, remember, we're in the death game, right? We deal with a lot of deaths. We deal with a lot of disabilities. We deal with a lot of business owners that things didn't work out in their life like they planned. So, you're bang on, Christina. They're going to go back a couple of years and look at this, and then it's going to be, it's too late. So what happens if there's a death? What happens if you're a disability? Or what happens if some guy just comes in and offers you a number for your business that is off the charts and you want to take advantage of that? Well, if you didn't do that active planning, maybe you're going to pay a lot more tax than you would have otherwise. So even if you're not really ready to sell, it still makes sense that, once your business is up and running, that you start talking to your accountant and say, is it time for me to have a holding company? Am I accumulating too many of those non-active assets inside my corporation? Again, great way to invest. But this lifetime capital gains exemption, the CDA or capital dividend account and corporate owned life insurance, which can incorporate all these sort of strategies, money, non-active business. What do you do with it so you don't have those passive income grind over 50,000? Corporate life insurance. How do you not have the growth? Corporate life insurance. How do you take some of these assets you can't use, that you're not using for active business, put them over there? Investments, ideally tax efficient investments, corporate owned life insurance. There's only a couple strategies left in Canada that business owners can take advantage of to really impact or lower their tax. And corporate owned life insurance, capital dividend account, and lifetime capital gains exemption are the three that every single business owner should be aware of, setting their companies up to take advantage of those three tax-free strategies. That's what we specialize in at Control and Compound. So if you're a business owner, please reach out. We're happy to help you. We love this stuff. Christine and I are both business owners. We incorporate this planning into our plans, and we're happy to share what we do, and we're happy to talk to your accountants. So that's it. Thanks for watching. Thanks for listening. Have a great day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controlandcompound.com, and you can sign up for an education session with one of our wealth coaches.